Okay, welcome to this video. In this video, I want to share with you a deeper understanding on the topic of risk to reward ratio, risk to reward ratio in the forex trading. Okay, so let's go straight to the point without wasting much time. Now, what is risk to reward ratio? Usually in every business, risk involved. Okay, so is in the forex market. There are risks involved in trading the forex market, and the biggest risk is the risk of losing your money in the trade. Okay, that's the risk of losing your money in the trade. But the idea in the forex is that you can actually determine how much you want to lose per trade and how much you want to profit per trade. Okay, if the trade goes in your favor, okay, you can decide how much you want to lose per trade and how much you are risking in a trade and how much you are targeted for your reward. Okay, that is basic idea in risk to reward ratio. So we're looking at the risk in a trade versus the reward in a trade. So your risk per trade is the amount of dollars in pips you will lose if the trade moves against you. That is the risk involved in that trade. How much you are going to lose in pips, in dollars, per trade if the moves or if the market goes against you after you have entered, while the reward per trade is the amount of dollars in pips you will profit if the market moves in your predicted direction. Okay, so that is the idea of risk to reward. The risk involved in a trade in terms of how much you might lose, and the reward involved in the trade in terms of how much you are going to profit in a given trade. Now, the summary of this little to have said is this: that there are risks involved in trading the forex market, which is losing your money. Okay, now risk to reward ratio is therefore the amount of dollars you are risking in exchange for the amount of dollars you are targeting for a profit. Okay, that is basic idea of risk to reward. So we are basically discussing risk versus reward. Okay, risk versus reward in the forex market. So how do you know your risk per trade? Okay, in terms of dollars, or what is the dollar value of your pips that has gone in your favor or that has gone against you? Okay, what's the dollar value? And the only way you can know this is simply convert the pips movement. Okay, the movement of pips involved, whether for your stop loss or for your take profit, just convert it to dollar. Okay, and I have done a table here for you to understand that. Okay, there's a table I have done here. Here is a table, and the table basically explains the pips, dollars, and the volume. Okay, so how much you are going to make in profit, or you are going to lose in a trade is determined basically by two things. It's determined by the volume you have selected and the pips you have, and the pips movement. Okay, what is the amount of pips involved in that trade? Okay, and what is the volume you have selected? Okay, so if for instance your volume is 0.01, which by the way is a micro loss, the smallest volume so far in trading. Okay, if you have moved 10 pips, 10 pips equals $1. If your volume is 0.02, if you have moved 10 pips, 10 pips equals $2. If you have moved, for instance, if your volume was 0.09 and you have moved 10 pips, 10 pips equals what? $10. Now, but if you are using one standard lot size, you can see how this is a one standard lot size. In one standard lot size, 1 pips means $10. Okay, 1 pips here means $10. So if you move 10 pips, it basically means $100 is involved. This may be your profit or it may be your loss. All depends if the market goes in your favor or it goes against you. Now I want us to look at the ray charts and put all this together. Okay, so here is a ray chart. Let's take a look at it and see how risk to reward is applied in the forex market. Okay, so let's look at this pair. Let's assume you are entering here for a buy. You are seeing that this pair is going to buy up. Okay, and your first target is here. That's Probably that is your first take profit target. Okay, now you want to enter for a buy up. Okay, let's see. Now here is the current price. This is the current price, and you want to enter immediately for a buy up. Okay, now that is your target profit. Okay, now your stop loss maybe somewhere here. Yeah, that may be your stop loss. Okay, so your risk here in this case is the red zone. This area in red is the risk. That means you have entered for a buy, but assuming the market, instead of buying, sells down, okay, that means you have lost money, but you are only going to lose only the amount, the space within the amount in red. Let's take another line now. Okay, so this is the only amount you are going to lose, only from this price to this price. Okay, from this price to this price, these are the only amount you are risking for this trade. This may be whatever amount of dollars, depending on the volume you have selected, and of course the pips involved in this small space. Okay, now in the same way, this will be your profit if the market goes in your direction. That means if the market goes as you have predicted, this becomes your profit. Okay, the space between here, this price where you enter, up to this your target. If price gets here, this becomes your reward. Okay, so this always, before you enter a trade, you decide your reward and you decide the risk involved. And the risk involved, usually it comes in pips, but you have to calculate it in dollars, so that you know in real dollars how much you are losing, or you may lose if the market goes against you, or how much you are going to win if the market goes in your favor. Okay, now I want us to look at some of the basic rules, if there are any. So, risk to reward rules. There are no rules, really. There are no rules in applying your risk to reward, but I think the biggest rule, or whatsoever strategy you are applying, your reward has to be bigger than your risk. Always, your reward has to be bigger than your risk. That is the only way you can make profit from the forex market. Okay, because you are going to lose some trade and you are going to win some trade. So if your risk is lower than your reward, even if for instance you enter 10 trades, you lose 5 and you win 5, you are still going to come up very profitable, because your reward has always been bigger than your risk. Okay, take for instance, if I'm risking $2, your target must be, for instance, $4. If you are risking, for instance, $6, that is your risk for that trade. If I'm risking $6, basically you'll be targeting at least around $20 or $24. Okay, that may be your target. If I'm risking, for instance, $10, you are probably targeting $50. Okay, so that is how it goes. Your reward has to be bigger than your risk, maybe double or triple, whatsoever the opportunity you are seeing in the market, depending on your entry strategies and your trading plan. Okay, so that is the basic rule. The rule is that always target a higher reward versus a smaller risk. That is the basic rules. Okay, now look at your chart and see what you can learn, or how you can apply your risk to reward in your trading strategy.